Welcome to This Explainer. Today, we are tackling an absolutely crucial topic: where your money should actually go. We're going to unpack exactly how to find hidden cash in your everyday life, and more importantly, how to put that cash to work for your future. Look, I know the finance world can feel like this dense, intimidating jungle of jargon, but today, we're clearing away the brush. We're going straight to the source material from the FTC, the IRS, and the SEC to build a simple, undeniable roadmap for your money. So, let's jump right in. But before we can even talk about where to invest, we have to answer the biggest question most beginners have, right? Where do I even find the money to start? It's literally the most common roadblock. You hear experts shouting, "You need to invest," and your immediate thought is, "With what money? My paycheck is already stretched to the limit." And hey, that's a completely valid point. But the secret that wealthy individuals understand is that you don't necessarily need a massive salary bump to begin building wealth. You just need efficiency. You've got to plug the leaks in your financial bucket first. Once you stop the money from dripping out, suddenly you have the seed capital you need to grow your future. Which brings us to Section 1, free up your cash. We're talking about reclaiming your money through audits and deductions. Okay, so let's look at two incredibly effective ways to free up your cash right now, giving yourself a raise without even having to ask your boss. Let's start with a massive drain on our wallets: subscriptions. The Federal Trade Commission recently introduced a final click-to-cancel rule. And get this, they received over 16,000 public comments about it. 16,000! That just shows how incredibly frustrated everyday consumers are with sneaky, recurring charges. We've all been there, haven't we? You sign up for a free trial with one click, but when you want to cancel, you're navigating a maze of hidden menus or sitting on hold for an hour. Well, this new FTC rule forces sellers to make ending a subscription exactly as easy as it was to sign up. And the data brilliantly illustrates why this rule is a real game changer. Just look at this jump. According to the FTC, consumer complaints about these recurring subscriptions jumped from an average of 42 a day in 2021 to nearly 70 a day in 2024. That is a massive spike in people realizing they're just bleeding cash for services they don't even use. So your takeaway here? You absolutely need to audit your recurring charges. Pull up your credit card statement tonight. Look for every single recurring $10, $15, or $30 charge. Slashing just a few unused streaming services can instantly free up $50 to $100 a month. Now, beyond canceling subscriptions, the second way you can keep more of your own cash is by understanding the tax code, specifically claiming your IRS deductions. For the 2025 tax year, the standard deductions are substantial. We're looking at $15,750 for single filers, $31,500 for married couples filing jointly, and $23,625 for head of household. Remember, a deduction is simply an amount you subtract from your income so you literally don't pay tax on it. Making sure you correctly apply your standard deduction ensures you aren't overpaying the government, which leaves more money sitting right there in your checking account. But here is the absolutely crucial point. You have to know the difference between deductions and credits. As we just saw, deductions lower your income on paper, but credits are the holy grail. A tax credit directly reduces the actual tax you owe, dollar for dollar. For example, the Earned Income Tax Credit is a refundable credit for low to moderate income workers. Since it's refundable, it can actually give you money back even if your tax bill is zero. Finding and claiming these credits literally puts direct cash back in your pocket, cash that you can now use to invest. Moving right along to Section 2, power of compound interest, turning a little into a lot over time. So you've got this newly freed up cash. Where should it go? If you leave it in a regular savings account earning basically nothing, like 0.01%, inflation is just eating it alive. Now, a high-yield savings account earning 4% or 5%, that's fantastic for short-term emergency cash. To put that in perspective, the real dollar difference is maybe $40 to $50 a year for every $1,000 saved, compared to a standard account. It's nice, for sure, but it won't build generational wealth. For that, we need the compounding journey, based on the SEC's Investor.gov compound interest calculator. Imagine you freed up $200 a month. On day one, you make your initial investment. Month one, you automate that $200 contribution. Year one, you earn your annual return. But years 10 through 30, that is where the snowball effect kicks in. You aren't just earning interest on your original money anymore. You're earning interest on your interest. A modest $200 a month doesn't sound like much, but left to grow over decades, it can snowball into hundreds of thousands of dollars. Time is your absolute best friend here. Let's hit Section 3, why choose index funds? The preferred vehicle for long-term growth. All right, you have the cash and you know the math, but what do you actually buy with that $200? According to the SEC, a highly recommended first vehicle is an index fund. An index fund is basically a type of mutual fund or exchange-traded fund that seeks to track the returns of a specific market index, like the S&P 500. So instead of trying to pick the one winning stock in a haystack, you literally just buy the whole haystack. It gives you an indirect investment into a broad basket of securities representing the market. Boom. Instant diversification. You're betting on the overall growth of the economy, not just tossing darts at single risky companies. What's really fascinating here is the contrast between passive and active investing. Index funds use a passive strategy. You buy, you hold, you aim to match the market. And, this is huge, you pay incredibly low fees because you aren't paying a team of Wall Street analysts to pick stocks. On the flip side, active managers trade frequently and rack up higher research costs trying to beat the market. But the data, it shows that over the long run, very few active managers actually pull that off, especially after you factor in their hefty fees. With index funds, you keep your costs rock bottom, meaning more of your money stays in that compounding snowball. Now, to totally supercharge those index funds, you want to place them inside tax-advantaged accounts. Think of these as a legal protective shield against taxes. You've got your pre-tax 401k, where the money you contribute lowers your taxable income right now, but you pay taxes when you withdraw it later. Then you have Roth accounts, like a Roth IRA. With a Roth, you pay taxes on the money today, but it grows completely tax-free and you pay zero taxes when you pull it out in retirement. So when does each win? Well, if you need the tax break today, a traditional 401k is great. But if you expect your tax rate to be higher in retirement, or if you just love the idea of completely tax-free income later in life, the Roth IRA is an absolute winner. Giving your money this tax shelter is absolutely vital. Which brings us to our final part, Section 4, 3-Step Action Plan, putting your knowledge into motion. We've covered the official frameworks and the math. Now it is time to take control. Here is your rock-solid 3-step action blueprint. Step 1. Audit and cancel unused subscriptions immediately. Use the FTC's momentum, find that click-to-cancel button, and ruthlessly cut what you don't use. Step 2. Claim your eligible IRS deductions and tax credits. Do not leave your hard-earned money on the table at tax time. Step 3. Take that newly freed up money, say $200 a month, and automate an investment into a low-cost index fund within a tax-advantaged account. Automation is the secret sauce here. Set it, forget it, and let compounding do all the heavy lifting over the next few decades. I want to leave you with a golden rule from Investor.gov. Fees and expenses reduce the value of your investment return. That applies to high-fee active funds, for sure, but it also perfectly applies to those forgotten $15 subscriptions bleeding your checking account dry. Every dollar you lose to unnecessary fees is a dollar that cannot compound for your future. So here's my question to you. Are you ready to stop paying everyone else and finally start paying your future self? Thank you so much for joining me on this explainer. Go put that blueprint into action today.